Hello. So today we are doing management efficiency ratios. In the last class, we did profitability ratios and long-term solvency ratios, right? Okay. So the first ratio is inventory days, or we also say it inventory holding period. What is the formula? The formula is average stock or closing stock divided by cost of sales times 365. Okay. Now, what is average stock? If opening and closing stock is given, listen students, if opening and closing stock is given, then you must use the formula of average stock. And how do we calculate average stock? Opening stock plus closing stock divided by 2. Very simple. Average stock is opening stock plus closing stock divided by 2. This is average stock, right? But in many questions in the recent past papers, opening stock, the examiner normally don't give the opening stock, so you have only one option, that to use the closing stock, right? No other option is left, so then you have to use closing stock, right? So what is the summary? If opening and closing stock, both stocks are given, then you use average stock. And how do you calculate average stock? Opening plus closing divided by 2. And if opening stock is not given, then simply closing stock divided by cost of sale into 365. Now one more thing, if you want answer in days, then use 365. If you want answer in months, so there are 12 months in a year, so multiply it by 12. If you want answer in weeks, then there are 52 weeks in a year, so multiply it by 52. Okay. Now, what is the meaning of inventory days or inventory holding period? That it means how many days stock stays with us. That means that the difference between the buying date of stock and the selling date of stock. For example, I bought the stock on 1st of January 2020, and I sold it on 20th January 2020. That means 20 days. Stocks stayed at my place 20 days. So this is my inventory days or inventory holding period, right? Now, the next question is this good that we have high inventory days, or we should have low inventory days? The answer is low inventory days is better. Lower is better. Why low inventory days better? Because if you hold stock for more days, you need to bear holding cost, which is risky, which is very risky, right? Okay. Now the question is, how can we reduce inventory days? Simple is that inventory normally, for a manufacturing organization, inventory normally stays in three forms. We have inventory in three forms. Number one is raw material. Number two is work in progress, that is WIP. And number three is finished goods. Okay. So normally inventory stays in three forms: raw material, WIP, and finished good. If you reduce these three periods, automatically the overall time period will be reduced. Now the question is, how will you reduce raw material period? By using efficient and effective management techniques. You might have studied the one technique of EOQ, economic order quantity. Order only that stock which is needed. Don't order extra stock. So obviously your this time first time period will be reduced. Second is work in progress. Work in progress, the production time, the time consumed in production. So if let us say your organization was labor intensive in past, but now you have converted into automotive organization. So if you convert your organization from labor intensive to capital intensive, or if you use technology, so automatically this period will be reduced. And finally, the finished goods. How can you reduce the finished good time period? By doing good marketing. Okay. or by reducing your price. Why? Because if you reduce your price, your stock will sell in speed, right? Okay, right. So if you reduce these three time periods, automatically the overall time period will go down. So the final words: inventory days should be lower. Inventory days should be lower. Now, on one very easy question: there are some business for which inventory days must be low, must be very low. You don't have any option, because if inventory days for those businesses are higher, your businesses will be finished. Your business will wind up soon. And that is for perishable goods. That is for perishable goods. Example: food items. So if you have high inventory days for food items or perishable goods, so you will be in extreme loss, right? Now I'm teaching you reverse commentary. Right now, what I taught you, that that listen to me, that lower inventory days is better, lower inventory holding period is better. But sometimes if inventory days is high, still you don't criticize your management. Sometimes when inventory days is high, still you don't criticize your management. And what are those exceptions? Let me write. This is the reverse commentary. Exceptions. Number one, prices about to increase. Number two, bulk discount. Number three, uncertain demand of finished goods. FG means finished goods. Number four is variable lead time by supplier. Okay. Now, what is the first thing? Now hold. Look at the formula first. In the formula you have closing stock. In the formula you have, be attentive, in the formula you have closing stock in the numerator. So if you are holding more stock, if you have more stock, so obviously your numerator will be higher. If you have more stock, obviously your numerator will be higher. And when your numerator will be higher, your final answer will be higher. So in short, a company who keeps more stock will have a higher inventory days. Okay, so it's better, if you want to reduce your inventory days, you must keep low stock. Okay. Now, I taught you initially that lower inventory days are better. I taught you initially that lower inventory days are better, but sometimes these are exceptions. If inventory days are higher because of these reasons, then do not blame the management. Okay. The first thing is prices about to increase. Prices about to increase. For example, I have my business of sugar. I deal in sugar, right? And I got some insider news from the government department that the next week government is going to increase the price 30%. Sugar prices are going to increase by 30%. I got this insider news. So now what should be my strategy? Now I should buy complete 1 year stock now. Why? Because after a week prices will increase by 30%. So if I buy more stock and I'll hold them, so I'll earn a lot in the future. So now holding more stock is not bad. Now holding more stock is not bad at all. Number two, bulk discount. Yes, sometimes we get a very big discount from our supplier. So at that time we don't look at our holding cost, we just buy it, right? Okay. Then number third, uncertain demand of finished goods. Uncertain demand of finished goods. Let us say we have a business with non-seasonal demand. Uncertain demand means anytime customer comes and asks a big quantity, and if we don't have ready stock, customer goes to the competitor. Customer goes to other shop, their competitor. So now, in order to retain my customer, I must have a big stock with me at every time. So now this is the need of my business. That's why holding more stock Holding more finished good is not bad now. Number 4, variable lead time by supplier. What is lead time? Just think it's a basic word. Lead time means the day when I order my supplier for stock, and the day he delivers the stock. The difference. For example, I ordered my stock today to the supplier, and after 10 days he delivered it. So the 10 days is the lead time. 10 days is the lead time. Okay. So, good suppliers are those suppliers who have their fixed lead time. That means if they say 10 days, so they deliver in 10 days, they are good people, right? But there are some people in the market, they are not reliable at all. Sometimes they deliver in 5 days, sometimes they deliver in 15 days, sometimes they deliver in 1 month. So they don't have any fixed words. So first of all, we should not first the first advice is we should not deal with such suppliers who don't fulfill their promises, right? But what if that supplier is the only guy in the market, or that supplier has monopoly? Then it's our compulsion to deal with that supplier. So now, dealing with that supplier, we have studied in our basic studies that we keep some extra stock with us, that is called buffer stock or safety stock. So in this case, point number 4, carrying extra stock for the safety is not bad at all. Carrying extra stock for the safety is not bad at all, right? So it's good now. It's the need of business. So, final words, lower inventory days are better for sure. But because of these exceptions, if your inventory days is higher, still do not criticize your management, because there is some objective behind it, right? Okay. Now, there is one more ratio, which is the reciprocal of this ratio. This is inventory days. The reciprocal ratio is inventory turnover. And I just use the word reciprocal. And the formula of inventory turnover is cost of sales divided by average stock or closing stock. That's it. And this comes in times. Okay. So hold a minute. Look at this formula, the new formula and the old formula. This is the old formula, and that one is the new formula. Look at the old and new formula. This is old formula and this is new formula. Just reciprocal, reverse formula, right? So inventory turnover in times means inventory turnover in time. Look at me. Inventory turnover in time means how speedily, how fast you are doing your sales, how speedily or how fast your stock is going out, how fast is your stock is going out to customers, how fast is your sales. So if your sale is fast, it's good for you. If your sale is fast, speedily your stock is going out, it's very good for you. So for this ratio, higher is better. For this ratio, higher is better, right? And for the above ratio, inventory turnover in inventory holding period in days, for that ratio, lower is better. Okay. So these two are reciprocal of each other. Don't forget the totally reverse formula. This one and this one. The above was inventory holding period in days, and this is inventory turnover in times. Turnover means inventory turnover means how speedily you are selling your stock. So high speed is good if you want to make sales. One more thing, just a thought. Sometimes it happens when you have high inventory days, that means your stock is not going fast, your stock is not selling with speed. So that means there is a pile up of closing stock in the year end, there is a pile of closing stock at the year end. So your current assets will be higher in that case. So you connect this ratio with liquidity ratio as well. You connect this ratio with liquidity ratio as well. Okay. And one more thing, you connect this ratio with asset turnover as well. In the last class we studied asset turnover. Asset turnover means how efficiently you are doing your sales. So if this speed is slow, if the sales speed is slow, that means your efficiency is also lower. So you connect this ratio with asset turnover as well. You connect this ratio with asset turnover as well. Just think over it. Now the second ratio is of the same head is debtor days, or we say it debtors. Again, same thing, average debtors. Now, the second ratio of this same head is debtor days or debtors collection period. Debtor days or debtors collection period, that means on average, how many days debtors takes our credit customers or debtors, our credit customers or debtors takes to pay us. That means the day we do credit sales, the day we do credit sales, and then the day we get the payment, that this difference is called debtor days or debtors collection period, right? What is the formula? The formula is very simple. In the numerator, normally we use average debtors. When we use average debtors, when opening debtors and closing debtors are given, so what we do, opening debtors plus closing debtors divide by 2, we do opening debtors plus closing debtors divide by 2. But if opening debtor is not given in the question, if opening debtor is not given in the question, then what we do, we use closing debtors divided by sales into 365. Closing debtors divided by sales into 365. Now, one more issue. Normally, in some books, it is written we use credit sales. Technically, credit sales are used, but in the latest questions, 99% latest question, examiner don't give separate credit sales. Separate credit sales are not normally given in the question. So we simply pick up the sales number. We simply pick up the sales number from the question. Okay. Times 365 means if you want answer in days, multiply it with 365. You want answer in weeks, multiply by 52, and so on. Now, this debtors collection period, it should be greater or lower? Definitely lower. it's better to collect cash early from customers, right? Why? Because number one, bad debts. If there is an inherent credit risk with debtors with credit sales. So if you delay more, if you give more chance to debtors, so there will be high possibility of bad debts, there will be high possibility of bad debts. So it is better to collect early from debtors, right? Okay. Then how can you just think, just an oral thought, how can you reduce debtors collection period? Number one, through negotiation. You can do negotiation with your customers. You can explain them that we need cash or we have some cash shortages like this. And the second method is by giving cash discount. By giving cash discount, hope you remember what is cash discount. You tell them that if you pay within 10 days, you will get 1% extra off. But don't forget, cash discount itself is a cost. Don't forget, cash discount itself is a cost to the organization. Okay, right? Now, so normally everybody says that debtor days lower is better, lower debtor days are better. Now let's start the exceptions game. Exceptions, this is exceptions. Okay, what do you mean by exceptions? Exception means sometimes increasing or high debtor days are not bad. Means if the debtor days of company is increasing, so no need to criticize the company. No need to criticize the company if the debtor days are higher because of these reasons, because of these exceptions. Okay, let's start the exception. Number first, marketing strategy. Marketing strategy. Listen, last year we were alone in the market, we had monopoly. So if you have monopoly, you can do anything, whatever you want to do, you can do. Okay, nobody can do anything. But this year you have many competitors in front of you. So in order to beat your competitors, in order to give tough time to your competitors, what you do, you decided to increase the debtor days. You decided to increase the credit limit of your customers. Earlier you were giving just 20 days time period to customers, now you are giving 60 days. 60 days time period to your customers. Why? So that they don't go to your competitors. You want to retain your customers. So it's a good strategy. Now you are increasing your debtor days with an objective, and that objective is the long term strategy. You need to make a long term customer base, and now it's good for the organization. Okay, so don't say that always increasing debtor days is bad, sometimes it is good. Number two, obsolete stock. Obsolete stock selling strategy. Yes, look at here. Let us say I have this pen. This is well, this is not a perishable good, but let us say I have this pen, and this pen will expire in 3 days. I have this pen, or I have some fruits which will expire in 3 days. So now I should sell them within 3 days, otherwise the value will be zero. So what I will do, I may give this product on 6 months credit. I will say the customer, take the product and pay me after 6 months. Because why? Because I know within 3 or 4 days that the stock will be of no value. You getting? So obsolete stock selling strategy. Giving you a practical example. You might have heard about a car named Centro, and in past they launched a car which was not of that much good shape, and finally the car got flopped, failed. But what Centro company did, they manufactured many cars, and the cars were sitting idle in the storeroom, so they had to bear big holding cost. So you know what they decided, what they did? They gave advertisement in the newspaper that take this Centro car from us on 5 years lease. On 5 years lease, look at me, with 0% interest rate. Take this Centro car on 5 years lease with 0% interest rate. That means pay slowly in 5 years without any interest. So in other words, Centro company increased the debtor days to 5 years. Why? Because the model was flopped, the car was flopped, and they manufactured a lot of cars, so they had to bear holding costs. So it's better to sell them. So it's better to sell them on any terms. So now again, this is not bad. Number third, this is a bit different. large credit sales just before the year end. What does it mean? It means, see, this is your accounting period. Every month I do this much sale. Okay, this much sale, very small amount of sale. And when the sale is small, your debtor is also small. So every month sale is small, debtor is small, sale is small, debtor is small. Okay, but let us say this is December is my year end. 1 week before the year end, 1 week before the year end, one customer came to me. 1 week before the year end, one customer came to me and he said, I want a big order. And he said, if you don't give me order now, I won't buy in future. I said, okay, no issue. So I did a very abnormal sale. I did a very big amount. I did a very big amount of, listen, I did a very big amount of abnormal credit sales at the year end. I did a big credit sales at the year end. So now throughout the whole year we did a small amount of sales, so small amount of debtors. But year end we have to do a big amount of sales. It was a one off event. So we did big sale, and by the year end customer didn't pay, so there will be huge artificial amount of debtors at the year end. So look at here, when the year end debtors will be higher, when the year end debtors will be higher, so the debtor days will also be higher. So now this is not the fault of management. Now this is not the fault of management. Throughout the whole year, debtors were lower, and the debtor days were also lower. But just because of the year end one off event, this happened. So do not criticize management for this. Do not criticize management for this. Management is not guilty for this. Okay, so now these are the exceptions. These are the exception for debtor days. Don't forget exceptions. Now the third thing is creditor days. Creditor days or creditor payment period. What is the formula? Is average creditors divided by closing creditors, or closing creditors, sorry, divided by cost of sales times 365. Okay, this is the formula. Average creditors closing creditors divided by cost of sales into 365. In simple terms, listen, when we use average creditors, when opening and closing creditors both are given. Look at me, you have done two consecutive ratios. When opening creditors and closing creditors are given, then what we do, opening creditors plus closing creditors divided by 2, we get average creditors. But what if opening creditors are not given, then we have only one option. Then we use closing creditors divide by cost of sales into 365. Now, sometimes in some books, there is one more formula is written, purchases. You write purchases in the denominator. But if you see the latest question, 90% latest question, purchases are not given. So we can use cost of sales. We can use cost of sales instead of purchases, right? Okay. Now, what does this ratio reflect? What is the meaning of creditor days? Creditor days means now how much time we take, to pay our creditors, how much time we take to pay our creditors. Now, it's good to pay late. This is the rule of business. It's good to pay late to our creditors. It's very good to pay late to our creditors, because definitely we will be using the money of our creditors. We will be using money of our creditors. This will be a source of finance. So higher creditor days are better, but but don't increase forcefully. What does it mean? Don't increase forcefully means, for example, you bought goods on credit and now you're not picking up the phone of supplier. you are delaying unethically, you are not answering your supplier. So this is unethical. If you do this, if you follow this approach, this will be a negative hit on your goodwill. Supplier won't give you priority next time. Even supplier will cancel your future orders. This news will spread in the market that you are not a good guy. You don't pick up the call after taking loan, after taking credit, you don't pick up the call. So that's bad. That's bad. Overall, that's bad. That will be a negative hit on your credit worthiness in the market, right? So it's better if you want to increase the creditor days, you can do negotiation with your supplier. You can say that we will buy big quantities in future and we'll only buy from you. So that's good. So through negotiation, you can increase, or by not availing, or if your supplier is offering you cash discount. If your supplier is offering you cash discount, don't avail that offer, because you don't need to pay early, you want to pay late. So they better don't avail the cash discount offered by supplier, right? Okay, now let me tell you, so let me teach you some different commentary, special commentary. This is company A, this is company B. Okay, wait. Creditor days for company A is 10 days, and here's it is 40 days. Okay, creditor days for company A is 10 days, and for company B, creditor days is 40 days, right? Okay, now reasons. This is very interesting. This is very interesting. Please look at here. What is this? Now learn one thing. When you do commentary, when you comment on the financial statement, you are not sitting with the director of that company. You are not sitting with the director of that company. That means you don't have any insider news of the company. You just have a piece of paper. That's the piece of paper, that financial statement, and you are doing commentary. So you have to use the language with maybe, can be, maybe, can be, could be, this may be possible, this may be, in this way we comment. Okay, right? Now, company A has creditor days of 10 days and company B has creditor days of 40 days. That means company A is paying its creditors in just 10 days and company B taking 40 days to pay its creditors. So what is the meaning? The first meaning is that liquidity of company A is very good and company B is bad, because company A is paying very early and company B is paying very late. That means company B might does not have the cash. Okay, so this is the one picture. This is the first interpretation, that liquidity of company A is better than liquidity of company B. Okay, now the second interpretation. Just think, company B got 40 days credit from the market. Company B got 40 days credit from the market. That means people in the market trust more. People in the market trust more on company B as compared to company A. They don't trust that much on company A. They just give 10 days credit. That means now we can say the credit worthiness of company B is better than company A. Okay, so these are the two angles, two different views of commentary, and we have to write both views, but by using the language maybe, can be, like this. Okay, please have a look. Now we are moving towards investment ratios. Investment ratios. The first is EPS, earning per share, already done in IS 33. Number two, price. Number three is dividend per share. Number four is dividend cover. Number five is dividend yield. Okay. Now, EPS you have already done, earning per share. Just giving you a 1 second recap. Earning per share means how much per share earning, how much company is earning per share, right? So this is the share of Unilever and this is the share of BMW. This is the share of Unilever and this is the share of BMW. Two pen in my hand. Unilever earning per share is 500 pounds per share, and Unilever earning per and BMW earning per share is just 100 pounds. So this share is earning 500 pounds per share. The second share is earning just 100 pounds. So whoever will earn more will be more valuable. So higher the EPS, higher the share price. In the stock market, this is basic rule that share price is dependent on majorly on EPS, earning per share, right? Okay, that's why earning news is also very important for stock market. When earning news comes in the market, stock price, share price moves, right? Okay, so EPS is dependent on share price. Now the second ratio, which is very important, that is price earning ratio. Now let me wait. In stock market, this is the formula of calculating market price per share. Look at here, market price per share. How do we calculate market price? Market price is basically the product of two ratios. Number one is EPS. Market price is dependent on EPS. Yes, I just taught you. And the second is price earning ratio, P ratio. That means market price is dependent on both of them. Market price is dependent on both of them. Student says, sir, I know what is EPS. EPS is earning, the reality of the company, earning, the real earnings. Yes. Then what is this P ratio? Wait, this P ratio shows the confidence of shareholder in the company. Now giving you few examples. Go slow, please. Let us say EPS of a company is $2. EPS of a company is $2 and the market price is $10. Market price is $10. So 2 multiplied by how much is 10? 2 multiplied by how much is 10? 5. So now this it's 5 times. Your P ratio is 5 times. That means people are paying 5 times of earnings to buy the share. People are paying 5 times of the earnings to buy this share. Okay, now hold. Look at the screen. Now let us say, let me change the share price. Now the share price is $20. Now the share price is $20 with EPS remains same, no change in EPS, and the share price becomes $20. So what will change? Your P ratio will change. Your P ratio will change. Now in this second case, now people are paying 10 times of earnings. Now people are paying 10 times of earnings. That means people are more confident. People are more confident than the confidence of people is boosted up now as compared to the last scenario. In the last scenario, people were giving just 5 times, and now people are giving 10 times of earnings. So in short, P ratio shows, look at the words. P ratio shows the confidence, this is the word, the confidence of shareholders in the company. That means how positively shareholders taking the company's policies, company's steps, company's strategies, how shareholders thinking about company's future, how the market thinks about the company's future. So giving you one more example, Apple company. Sorry, first example is budget. You know, in every fiscal year, with the change of fiscal year, new budget comes in every country. Like in UK, the fiscal year is April to March. It's 6th April to 5th April. So in every April, you get a new budget. In Pakistan, the fiscal year is 1st July to 30th June. So normally budget comes in June in Pakistan, right? So sometime it happens that in the budget, government indicates in the budget is for the next year, okay, the next fiscal year. Sometime it happens in the budget, government indicates that we will be spending too much on construction. Government indicates that we will be spending too much on the construction. And you know what is the basic ingredient of construction? Cement. Cement is one of the basic ingredient of construction. So when such announcement comes in the budget, listen, the share price of cement companies goes up on the same day of announcement, the share price goes up. Now students think that, sir, with this announcement there is no change in EPS. With this announcement, just this is just an announcement. The real sales will be done in the future. The real sales will be going in the future, next few months. Right now, just announcement by the chancellor, and just with this announcement, the share price goes up. So share price is going up and no change in EPS. So what thing has changed? What has changed? This P ratio has changed. This P ratio has changed. That's why the price is going up, because the shareholders are confident now that there will be big sales in future. So this P ratio ultimately hits your share price. This P ratio ultimately hits your share price. Okay. Second example, Apple company. There was a time when I used to follow Apple company shares, but now I don't follow that much. But in past I used to follow. So one day what happened? The share price was $490 in the night, and when the next day I woke up, it was around $510 or something. So the application, I have just searched in the application, what is the reason for $20? $20 is a major change. So I searched the reason. So it was written there that there was a very famous sales head of Burberry. There was a very famous sales head of Burberry. You might have heard this brand. That this sales head announced that from after a few months I'll join Apple company. After a few months I will join Apple company, and just because of this announcement, the share price of Apple company moves. Now just think, when this major, very super hit lady, this lady will leave Burberry and she is going to join Apple. So yes, in the future she may be beneficial for Apple, and Apple company's earnings may go up in the future. But why the share price change now? Because of the change in P ratio, because of the change in confidence, right? Okay. So what price earning ratio reflects? Price earning ratio reflects price earning ratio reflects. So price earning ratio shows the confidence of shareholder in the company. Now, let me tell you the real formula of price earning ratio and then some more discussion. See, you are multiplying P ratio with EPS to get the market price. So if you want P ratio alone, so just divide EPS on the other side. So this will be the formula. Price earning ratio equals market price per share divided by EPS. Okay. Now, one very basic question. When you are an investor, when you are taking an investment decision, which company you should invest in, the company with high P ratio or the company with low P ratio? As an investor, which company you should invest, the company with high P ratio or the company with low P ratio? Well, let me tell you the words of Warren Buffett, one of the very famous investor of the Wall Street. He says he normally picks those stocks, those items with low P ratio. With low P ratio. Why? High P ratio means the price has already increased. High P ratio means already the price has increased. And low P ratio means the price will increase in future and there is a growth opportunity in that stock. Wait. Let me tell you. For example, the EPS of our company is $1, okay, and the share price is $5. Look at here. EPS is 1 and the share price is 5. So 5 on 1, the answer is 5 times. Okay. 5 divided by 1, the answer is 5 times. Look at here. Now the second case. Let us say the EPS is 1 and the share price become 10. So the answer will be 10 times. Okay. So in the first case, we are just paying 5 times of EPS. We are just paying 5 times of earnings to buy the share. In the second case, we are paying 10 times of the earning to buy that share. That means we are paying high price. That means with high P ratio, the price has already increased. So there will be less opportunity for more increase, for more jump in the price. So it's better to buy low P ratio stock with research definitely. Okay, because the reality is EPS, the reality of company is EPS. This second company is far away from the reality, 10 and 1, and the first was 5 and 1. So the first company was close to reality and the second company was far away from reality, right? So high P ratio means the price has already increased too much, so that will be a bit more risky stock according to me and according to Warren Buffett. You can read. Okay, right? Now there is one more ratio which is just the formula, that is dividend per share. Dividend per share, the simple formula is total ordinary dividends okay, total ordinary dividends divided by total number of shares issued. Total number of shares issued, this is dividend per share, this is dividend per share. Okay, right? Simple. And yes, this shareholders also consider, shareholder also values the per share dividend. When it happens sometimes that the last year the dividend per share was $2, but this year company just decreased to $1 per share. So this also hits the affects the this also affects the share price and the perspective of shareholders in the market. People, shareholders see that why company, shareholder investigates that why company did not give the dividend, what was the reason. So companies directors sometimes give explanation that we are doing big investment somewhere else, that's why we don't have that much cash to give you dividend. Okay, right? Or no dividend sometimes indicate that company is reinvesting a lot, just like Amazon nowadays not giving that much dividend, so Amazon is on the reinvestment strategy, and that is also a good strategy. Then dividend cover. DPS means dividend per share. Okay, don't forget, DPS and dividend per share is same thing, don't forget. Okay, look at here. Dividend cover. Dividend cover. The formula of dividend cover is EPS, that is earning per share divided by dividend per share. Earning per share divided by dividend per share. Okay, the answer comes in times. What dividend cover shows? Look at the words. It shows the dividend paying ability of a company. It shows the dividend, how much dividend company can pay, and are the dividends real or fake. This ratio will also indicate this issue also. It shows the dividend paying ability of a company. Now, giving you two companies, this is company A and this is company B, two companies in front of you. Look at the screen. You have two companies in front of you. The first company's EPS is $10, and out of this $10, the company is distributing $8. Out of this $10, company is distributing $8, right? And company is retaining $2 per share. Company is retaining $2 per share. Company is retaining $2 per share. Okay. And the second company's EPS earning is second company EPS is $10, and out of this $10, company is just giving $2 dividend and $8 retained. Okay. Now you are a shareholder who wants consistent dividends. You are a shareholder who want consistent dividend. Now you tell me, I'm giving you 30 seconds. Which company is better to invest? The first one, the A or B? A, out of 10, $8 dividend they are distributing, and B, out of 10, they are distributing $2 dividend. Which company is better? Tell me. This is better. This is better. Now let me discuss this issue, that why B company is better. Listen, if you have a very short term view, that then A company might be good for you, otherwise B is for sure better. Why? You know, in real life the profits are volatile. Profits changes every year. Profits changes. Listen, so this year the EPS for, I'm talking about the company A. Look at the company A. This year company A EPS is $10. What if next year this EPS become $6 or $5? So when your EPS will become $6 or $5, so do you think this company can pay $8 then next year? No. So that means these dividends are not sustainable. These may not be a consistent dividends. Okay. Now let me write again. Now, but for this company, the second company, right, B company, this year EPS is 10. What if the next year this EPS becomes $6? Still this company can easily pay $2 dividends. So in terms of dividend paying ability, company B is better. In terms of dividend paying ability, company B is better. In terms of dividend paying ability, company B is better. Okay. Now the commentary number 2. Wait. Company A is distributing Company A is distributing 80%. Company A is distributing 80% dividends. That means company A might not have good investment opportunities. No good investment opportunities. Don't forget this. If you are giving a lot of dividend, almost 80-90% dividend, that is one reason. One hint that you don't have any good option of reinvestment. But company B is giving just $2 out of $10, just $2 pocket money, and remaining $8 they are reinvesting, and they are making most of it. They will give return in the form of share price in future. You're not getting. Giving you one example. Just think. I'm an individual and I have $1 million, and the same $1 million Unilever company has. I also have $1 million and the same $1 million Unilever company has. Which can multiply into 2 earlier? I have the option to multiply this 1 million in times 2 earlier, or Unilever company can multiply it earlier. Obviously Unilever company, because I'm just an individual. I don't have any insider news. I don't have any opportunities. I don't have a team of CFA Unilever company is a very big company. In one single warehouse, they have more than 200 products. They have everything, shampoo, lot of opportunities. So they have chance to multiply this amount into 2-3 times earlier. So that means if money is with the limited company, is money is with the investment is with the limited company can multiply it faster than individual, right? Okay, now let's calculate dividend cover for both companies. For the first company, first look at the formula. The formula for dividend cover is EPS divided by DPS. So the first company EPS is $10. Look at here. For the first company, EPS is $10 and DPS is 8. So 10 divided by 8 is 1.25 times. 1.25 times. The first company dividend cover is just 1.25 times. Now let's come to the second company. Second company's EPS is $10 and DPS is just $2. So 10 upon 2 makes 5 times. Okay. So now I just proved you that the second company is better. So that means higher dividend cover is better, because dividend cover means dividend paying ability of the company. So if the dividend paying ability of the company is higher, it's good for shareholder, for those shareholders who wants dividends. Okay. So higher dividend cover is better. Higher dividend cover is better. Okay. So 5 times is better than 1.25 times. Now wait. Now I have a quiz. What if what if there is a company with dividend cover zero point 0.6 times? This may come in any exam. There is a company with dividend cover of 0.6 times. 0.6 times means less than 1 times. 0.6 times means less than 1 times. What does this indicate? Think over it. Giving you 20 seconds. Giving you 20 seconds. Think over it. What do you mean by dividend cover 0.6 times? 0.6 times or 1 times, less than 1 times means, wait. How do you get 0.6? How do you get 0.6? That means 6 is your EPS and 10 is your dividend. 6 is your EPS and 10 is, then the answer will be 0.6 times. Okay. 0.6 means less than 1. And how it becomes, then 6 is keep 6 in the numerator and 10 in the denominator. So 6 upon 10. So EPS is 6 and DPS is 10. So if dividend cover, final words, if dividend cover is less than 1 times, it means you are paying more dividend than your earnings. If dividend cover is less than 1 times, it means you are paying more than what you have earned. That means you are distributing your old retained earning. You are giving dividends from old retained earning. These dividends does not belong to the current year earnings, because in the current year you earned $6 and you are paying $10. Does it make sense? That means you are paying from your old dividends. And normally company does this when company wants to create artificial confidence. When company wants to create artificial confidence of shareholder, and this is all fake. These are not real dividends. That's not your ability. You are paying more than what you have earned. That means you are taking out old money from the company. Okay. So don't forget this. Now look at it. Dividend cover is EPS upon DPS. Dividend cover is EPS divided by DPS. This time I have used per share, earning per share and dividend per share. Both numerators and denominator are per share formulas. Sometimes when per share figures are not given, then you use total earnings, and total ordinary dividends. Repeat. Right now I have written the formula of per share, earning per share and dividend per share, both per share. Okay. So when per share data is given, then use both data per share in numerator and denominator. But if per share data is not given, then then my dear, you use this formula. Dividend cover is equal to total ordinary dividends divided, sorry, then you use total earnings means profit after tax, PAT, divided by total ordinary dividends. Earnings means profit total ordinary dividends. So this formula is also used. This formula is also used for dividend cover when per share dividends are not given. When per share dividends are not given. Okay, have a look, please. This is the final. Okay, so last ratio of this field is dividend yield. Okay, DPS is dividend per share divided by market price per share into 100. Okay, now hold. Let us say the face value which is given by law, the face value of one share is 10 pounds. The face value of one share, let us say, assuming it's 10 pounds. Okay, right? And company is giving dividend of 2 pounds. Dividend, company is giving 2 pounds per share. Okay, so what happens sometimes, this is the requirement of company law in many countries, that whenever company announces the dividend, look at me, whenever company announces the dividend, they announce dividend as a percentage of face value. They announce dividend as a percentage of face value. So $2 the dividend and face value is $10. So they will announce on the media that we are giving 20% dividends. We are giving 20%. So you as a shareholder, you will think 20% is too much. 20% is a very good number. But you know why 20% is looking attractive to you? Because they are calculating it as the base, face value as the base. They are doing this calculation with face value as the base. But just think one reality. Normally shareholders do not buy shares on face value. They buy shares from stock market. They buy shares from stock market. And when you buy shares from stock market, you have to pay the market price. And let us say the market price of this share is 100 pounds. Yes, this is possible. Face value is 10 pound and the market price, the current market price is 100 pounds. So just think, as a shareholder, as an investor, I bought this share from stock market. I bought this share from stock market by paying 100 pounds. And in return, now after investing 100 pounds, now I'm getting 2 pounds dividend. So my dividend per share is £2 and my market price per share is £100 time 100. This is my real return. This is my dividend yield. This is my dividend yield, or I must say this is my real return. Okay. So dividend, what is dividend yield? It's a real return, real return of dividend, real return of share in terms of dividend. So dividend yield is 2%. Dividend yield is 2%. Now, for your information, normally this ratios is taught in detail when you do stock market analysis, when you study CFA type qualification. Okay. Dividend yield, it is normally compared it is normally compared with bank interest rate, because we have one other option. We can park our money in banks, okay, in fixed deposit accounts, so we get interest rate, so we compare it. But one more thing, don't forget, just my last words, that when you buy, just think as an investor, when you buy a share from stock market, when you buy a share from stock market, ordinary share from stock market, how many returns you normally get from the stock market? Two types of return. Number one is dividend. Dividend is first return, and the second return is capital gain. We also enjoy the capital gain. Okay, so if this dividend yield is less than interest rate, so no need to worry about it. For example, the interest rate is 5% and dividend yield of share is 2%, so you don't need to cry, because you will earn one more thing, the capital gain. In fixed income you don't have any capital gain. If in fixed income you don't have any capital gain, but yes, in this area you have, in ordinary shares, you not only you will enjoy the dividends, but also you will enjoy the capital gain. Okay, right? So I hope you got the point. These were the investment ratios. Investment ratios are normally used by the stock market investors for before taking any investment decision, right? I hope you like the lecture. Okay, bye bye.